Welcome back, everybody. Doug Version here. What if I told you you could pay zero taxes legally as a small business owner? What if I also told you that according to recent surveys, 45% of small business owners don't have a formal retirement plan? And to make it even worse, around 30% have no savings at all. Stay tuned. We're going to go through some strategies where we can really legitimately cut your taxes to zero as a small business owner. We'll start with simple and we'll work up to more complex and give you a good overview because time is closing fast for this year, but there's still time that you can take advantage of these plans. Okay, I'm not going to get into too much detail, but I just want to give you a highlight. Some of these you'll really need to work with your financial planner to come up with the strategy that's best for you. But I want you to know what they are, how much you can do, and what your deadlines are. So let's go through that real quick. The first one, and the most common one you're going to see as a small business owner, is a SEP. Why is a SEP great? Because it's easy. You can do a SEP all the way up until the filing deadline of your tax return. They do have some limitations though. So who is a SEP best for? Well, in my mind, a SEP fits best for a solo business owner. And the reason is whatever you give to yourself, you have to give to everybody that works for you. Now, how does this work? That's not 100% true. If they don't work full time, there's hour limits, all that. We can maybe cover details of it, but I'm just trying to give you a high level. The way it works is if your salary was $50,000, you can contribute up to 25% of your salary to the SEP-IRA, and that IRA is now your IRA, but it's pre-tax, but it has to be funded by the business. But if you give 25% to yourself, you also have to give 25% to all other qualifying employees. And there are some minimum limits for every so many years. Like I said, we can get into details. I just want you to know what's going on here. The reason it's not necessarily the best if you have more employees is, one, they can't defer their own income, and that can be a big deal. What if they want to take some of their own wages and defer it? That doesn't work. Only the business can fund a SEP. Now, what if you're a sole proprietor and you don't actually have wages? That works off of your profit. So it's going to be 25% of the profit, to keep it simple, of the business. So if the business made $50,000 on your Schedule C, you can do 12.5. Your tax preparer, your financial advisor can get you the exact details, but that's close enough so you understand how it works. So they're really good. They're really easy. You don't have a lot of plan documents. You can set them up really fast. You can file them up until the filing deadline of your tax return. So what does that mean? That means you didn't do anything this year. In March, we're preparing your corporate return, or April, you're preparing your individual return, or if you file an extension, that could be in September or October, depending on which type we're dealing with. And you could say, you know what, I had a good year last year. I would like a tax deduction. Let's go ahead and fund my SEP before I file this return. And you can go ahead and fund it next year and get a deduction for last year. That's pretty cool. And if you're whatever tax bracket is, that could save you a lot of money because that's deductible for both federal and state in most cases. Let's move along to the simple. And this is the one that I probably see more of than anything else. And it's like it says, it's simple. What makes it simple is it just is a lot less paperwork and a lot less compliance than a 401k is. Much cheaper. You don't have all the costs associated with a 401k. So for a lot of businesses, this works out really good, but the simple does have some issues. For one, if you wanted to do a simple for 2024, we've already missed the deadline. What's the deadline? A simple has to be set up by October 1st. That means we already missed the window of that. So if you want to do a simple, you're going to have to start with your 2025 year. So the simple's already closed. But it's a really good time right now to set one up for next year. Okay, so how does a simple work? Well, simple, I mean, not to use words that are goofy, but a simple is basically like a simple 401k. your employees, including yourself, you can contribute up to $16,000 to your simple. If you're over 50, you can also do a catch-up of $3,500. So that gets you up to $19,500 if you're over 50. If you want to get a plan going, you don't want to spend a lot of money, but you want to start putting some money in. And then think if you have a spouse who works in the business too, we can get up to almost $40,000 just with a simple, and we don't have to incur a lot of cost. It also allows our employees to contribute, and they can start deferring money. That's a big benefit, especially when we're talking about employee retention and trying to compete with maybe bigger firms. You can set up that retirement plan. Most employees aren't going to go above 16 anyway, so that makes you competitive with your competitors. And it has a 3% match. So if they do 3%, you got to do 3%. If they do none, you don't have to do anything. So it's a really nice way to go. So you can go lower, and you can go down to as low as 2% for 2 out of 5 years. But as a general rule, if you're going to go the simple, just plan on doing 3%, but know it's there. But it's a really good way to dip our toes into the retirement world and start doing it. And the nice thing is, those contributions, that 3% match, that's tax deductible for you. On top of the fact that we're deferring part of your salary into this simple, so we're saving taxes there. Depending on your tax bracket, that could be a big savings. You know, most of our clients are in the 22, 24% tax bracket, and then you put 5% on average for a state. If you put in $10,000, you just saved $3,000 in taxes, and it's your money. Now, I know some people, we can talk about Roth, whole nother strategy. We can talk about that a different day, so don't tell me about all that. I understand that. Right now, we're talking about saving tax today. Okay, now there's also, it's a little bit newer, it's what they call the solo 401k. And this one is really nice for what it sounds like, you solo practitioners out there, you solo business owners. You want to do more than the 16 or the 19.5 if you're over 50. You don't have any other employees, so we don't have to worry about a lot of the compliance standards. We can go up to $30,500, I believe. Yeah, I should know all these, but they index them every year, so leave me alone. There we go. So it's $23,000 and then a $7,500 catch-up. So like I said, $30,500, or if you're below 50, you can do $23,000. So this is a significant step up in how much we can contribute versus the simple. Still a fairly inexpensive plan to operate because we don't have any other employees. So we have a lot of people doing these. These are great. Now, what if you're a sole proprietor, Schedule C, for instance? Now, those, a little different, same basic concept. On those, you're limited to 20% of the profit of the business. So if your Schedule C profit that we're getting taxed on is $100,000, we can go ahead and put $20,000 into our solo 401k. Cool thing is about these is these can be set up anytime prior to the tax filing, much like with the SEP. Details, get with your financial advisor, your tax professional, work out it. But if this is February, March, you're doing your tax return, not like the tax results, but you had some extra money in the bank because you had a good year, this may be a good way for you to go ahead and get that funded. And if you put $30,500 in, and we're in a 24% tax bracket plus stake, we're almost saving $10,000. We're now saving real money. So that's a big deal. That's your solo 401k. Now, moving along, for most of you, it's going to be the safe harbor. That's where you're going to generally deal with employees. You got a safe harbor 401k, you've got employees, same limits, $23,000, $7,500 catch up. Your employees can also do the same thing. The match part gets a little more complex there, and because we have to make sure everything is okay, these plans start getting more expensive. The nice thing is when you set up one of these plans, there are tax credits to help offset that, but I don't want to get into the specifics of that here because maybe we can do that another time, because too often I hear people promise that you're going to get a tax credit, but they don't know your tax situation, and I've seen a lot of times when people didn't qualify because the taxes are being wiped out by other things. So be careful with credits. Make sure you talk to a tax advisor to make sure you have enough tax for that credit to apply. But chances are, if you're doing one of these plans, you probably will. Once again, though, same thing. The cost for the plan, that's tax deductible. The deductions are tax deductible. The match for your employees, tax deductible, and you're giving a really nice incentive for someone to come work for you versus maybe one of your competitors. So a lot of good retention quality there as well. Downside is they cost more to operate. And really for the deferral part, it needed to be set up by the end of the year. There is some stuff there where we can do the match part from Secure Act 2.0, but worry about that with your financial advisor. If you don't have one set up yet, there may still be an option there, but really at this point, the big advantage is going to, for most of you, is going to be in 2025. But right now, if you get on this right away, you could still get a deferral in before December 31st and take advantage of it. And that's why I'm doing this today. All these plans, except for the simple, you can still get done if you hurry this year. You just got to find somebody willing to help you. But you can still get that done and you can still save a ton of money. So if you and your spouse are both in the business, you can defer $61,000 if you're over 50. That's a lot of money. We could save $20,000 in taxes just like that. Well, it's more than that. But you understand what I'm saying. So this is a really big deal. Don't sit on this if you think this is you. Okay, so let's say you went with the 401k plan. I love this next part. It's one of my favorite parts. Any of my clients that set up a 401k, I always want to make sure they set up the profit share. I love the profit share, and the reason is you can fund the profit share all the way up until the filing deadline of your tax return. So if you've got an S Corp and you filed an extension because you want to see how things go, we can wait all the way until September to fund this profit share. And that profit share is 25% of your wages. So if you made $100,000 in wage, we can fund $25,000 additional dollars for your profit share in September and get the deduction on our 24 tax return. That is really, really cool. You can also do that for all your employees. If you got a lot of employees, you may not be doing a 25%, but maybe when all the numbers wash out, you're like, you know what? These guys did a good job for me this year. I want to do a 10% across the board for everybody profit share and not pay it till September. And your staff gets the benefit of that and you get the deduction for last year. That's pretty stinking cool. And it's tax deductible. Depending on how much you do, that can be massive, massive tax savings. Now, this last one, and that's why I said at the beginning of the video, you could pay zero tax. And that's the cash balance plan. And we'll probably do another video and do charts and go through these things because these are super cool. I just want you to know about them. What's a cash balance plan? Essentially, a cash balance plan is where we're going to set up a 401k. A lot of times we're going to have a profit share too. But now we can do probably a defined contribution plan, but where we can defer a ton of money. Where I see this happening most often, think your dentist. So the dentist is maybe getting close to retirement, 60, 65 years old. The assistants and the hygienist, maybe they're 30, 35, so he's a lot closer to retirement. You can see the same thing with insurance, really any business, especially if the owner is quite a bit older than his employees. You can wait one of these legally, a third-party administrator, they'll do all the actuarial work, they figure these things out. I've had clients that have been able to put $300,000 a year into their retirement plan and basically almost wipe out their tax completely. I've got several I'm working on right now that are similar type concepts. So we could basically take the money that they've been able to set aside in the business, it's excess profits, they haven't distributed it out. We could then take that, live off of the distributions, or if they have money in another account so they don't need the distributions, which is probably more likely to be the case, we can live off of this money we have in these other accounts and defer all of our money, not all of it, but a lot of our payroll, and then a big profit share on the back of it. And then the business profit drops down to almost zero. and bam, you aren't hardly paying any taxes. You kept it all, and it's an amazing way to supercharge your retirement on those last few years. While you're in your peak earning years, you're in your peak tax brackets. We can take advantage of this. And then once you retire, yeah, most of you are going to be in higher brackets than you probably thought, but we may not be in nearly as high as we are during these years. Take that tax break, and then we can start working on other strategies once we get retired and sell the business. These things are awesome. They're for a unique set of people, but you truly can drop your tax down way, way down. I've seen some really cool ones, but we got to get an actuary in there. The TPA, which is a third-party administrator, does all the math, sees if it works, sees how much we got to pay everybody, and then go through the tax strategy. I got one here that's just an example. This is an example one where you had two owners. They took out $345,000 apiece in wages, but they were able to contribute $669,000 to this cash balance plan and save $301,000 in taxes. That is tax savings, people. That is awesome. I wanted you guys to know about that. If you found this stuff helpful, please subscribe. A lot of these, there's some nuts and bolts in them. We'll probably do some separate videos to help you understand how they work specifically. But I wanted you to have the whole overall plan right now, because if you've got some income, you're worried about the taxes, you still have a few weeks to fix this and save some money. And even if you can't get a 401, don't forget that we have that SEP and some of these new 401k plans that we can fund all the way up until the filing deadline. So don't believe that you've missed the boat without checking. So with that, like I said, subscribe, leave any messages or questions below. Glad to help, and we'll talk to you soon.